Welcome back, everyone. Today's video is not going to be debating growth versus value. It's not going to be preaching or saying one is better than the other. I just wanted to talk about growth stocks, and I see a lot of people wondering, or I feel like there's a few misconceptions out there about, are growth stocks risky? Are they riskier than value? And that's just what I wanted to talk about today. So I hope you enjoy. So growth stocks do seem to be fairly popular right now, and that's fine, and it's good for the growth investors who were invested before. However, some people would point out that some of the move up in the growth stocks has all been about multiple expansion. So let's say a company was priced at 10 times earnings, now priced at 20, was priced at 20, now priced at 40. That means the stock's doubled. But did the growth actually change? Maybe, maybe not. Depends. But the share price moving around, going from 10 times earnings to 20, 20 to 10, that's not necessarily risk. So what I am going to discuss today, and a lot of growth stock people will talk about, oh, the share price can go down a lot and it's time to buy. It may well be the case. But today I just want to discuss what actual risk is. What is the risk of something happening that will cause a company to fall and permanently fall versus volatility, because it's different. And I don't think it's as straightforward as many people think. Now, I'd like to start this video with a Buffett quote. Buffett said, "Price is my due diligence." And keep this in mind throughout the video. And while many of you are probably thinking at this point, yeah, but Buffett's a value investor. Well, I mean, Buffett has had some monster growers over time too. And the point being, he got in at a good price, a value price on a growth company. So just look at Geico if you want an example. But keep it in mind, price is my due diligence. So in isolation, I will say that growth is almost always good, probably always good. However, not all growth is created equal, because one thing you have to consider is a company growing because they are issuing shares to buy the growth and not growing per share? Well, that's not that helpful for shareholders if you're just going to issue tons of equity to buy something that could have some value later, but you have less of what you already own. That's one thing. Another thing is, if you're spending $10 for $5 in sales, that's not exactly a secret to success. Although recently it does seem to be a secret to making your stock go up. But hey, maybe at some point you can achieve economies of scale or whatever. But if you're spending $10 for $5 in sales, not really great business. But if you then spend $100 for $50 in sales, hey, look, you have growth. You have massive growth. So be careful for things like that. And just be careful, because this is the type of thing that requires higher and higher equity prices. If the stock stops going up in this scenario, well, then the company just can implode, and that really, there's nothing to stop it. There's no fundamental backing for the company. And that leads me to the first major risk in growth stocks, and that is, if you're in a company that is growing, 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 and I'm using air quotes here, too bad you can't see, but they don't make any money, well, then they still need money. They still need money to execute their growth plans sometimes, and that money comes from share price, well, issuing shares. So if the share price falls, then money becomes more expensive. And so while a stock is hot, while everyone's excited about it, they can just issue shares and make tons of money and no one cares. But if for whatever reason the company stops being the next best thing, well, then finding money becomes hard, because in addition from the share price, maybe let's say it's 50 when everyone's excited, falls to 10 because people find the new flavor of the month. Well, if they need money, then people might be, okay, we'll give you money, but at $5 a share, not 10. And that's your risk, because once shares are issued much, much lower, it becomes very, very difficult to regain the higher price. You need an immense return on that equity. And that is how permanent losses can happen in certain growth scenarios where the growth is not in a profitable company. But now you may be saying, okay, but I have a company that is actually profitable and they're growing earnings and they're going to grow so much bigger. And that's great. And they may well succeed. And in those cases, growth, there are some growth stocks out there that I don't think are ridiculously priced. I know there are some people that will say, oh, all stocks like XYZ are very expensive. I disagree. I think there are still some growth stocks out there that are very fairly priced if they can keep up their pace of growth. And there's the catch. Because if a company is growing at a certain pace, that tends to be what the market can price in. And so the market is expecting that growth. And if that growth stops, then we have a problem. So to clarify what I'm saying is your real fundamental risk in growth companies is that if the growth slows. So I thought the best way to look at this would be to use a world example. Alphabet, Google. Today, it trades at just over 33 times earnings and 28 times forward earnings. Now, value people might look at that and say, ugh, ugh. And okay, that's fair. But let's go into some quick math. So Google or Alphabet, whatever you want to call it, has a great earnings growth track record. And you can see by their results of the past decade or so. And some people will say, oh, yeah, they've grown. The share price has gone up so much and now they're overvalued. Maybe, but what would happen if they continued growing their earnings at 20% compound annual growth rate? That's what CAGR stands for. For those of you that are new, I know most of you probably already know that. So year zero, which was last year, PE 33. That's high. Okay, year one, that's next year, first year you care about as an investor, probably. 28.3, still high. Year two, 23.5. Okay, that's not crazy for a company like Google. Third year, under 20, 19.6. Getting there. Year four, PE of 16.66. For Google, that's starting to look interesting. Year five, well, PE of 13.61. And that's all of this is assuming today's share price, just earnings growth. 13.61 in 5 years. That's below the market. Now, 5 years isn't tomorrow, but if you look at a price to earnings on a company with no growth, it maybe at like 14, starting to look interesting. Anyway, year six, PE of 11. Okay, now that's cheap. Then year seven, PE of under 10. Year eight, under 8. Year nine, under 7. We're starting to get to a point where if this growth can continue for that long, and as I said before, if it can, Google may be fairly cheap where it is now, even though it's gone up so much. If they can't, well, let's get to that. So the risk with something like Google is maybe they can't keep growing their earnings at this pace because I'm just kidding, except I'm kind of not. You know what I mean? Anyway, let's say for some unknown reason, there's some power that decides to interfere, or some competition maybe that slows or stops the growth. While the market will likely be fine with the price as if growth continues as advertised, and if it isn't, I mean, I'm not saying the stocks are perfectly mathematically in tune to earnings, but there's some emotion involved. But either way, over a certain period of time, if the earnings continue, then there's not really an immense amount of fundamental risk. But if they don't, like what would happen if Google's compound annual growth rate going forward slowed to 5% from 20? Now that is a substantial slow, but it would still be growing. Well, you could look through the numbers here because I use the same base, and you can kind of see how much more slowly the PE will drop over time, meaning it would take almost a decade for it to get to around the level of the other staples instead of a decade to get to 6 times earnings, which would be probably pretty cheap. In this case, I would say it's fair to say that there's valuation risk if the growth slows. If it doesn't, then I mean, it's what price you're paying. Again, remember what I started this with. And the same thing applies for hyper growth. Again, my quotation mark fingers are getting their work today. I hate that word, hyper growth. But the same thing applies. If a company is growing at, let's call it 100% year over year, then the market can look out to whatever. Because let's say you have 100 million in, let's call it earnings year one. If you project that out 100% year over year compound annual growth rate, by year 10, you'd be earning $51 billion. So all of a sudden, you're projecting this company that's maybe tiny within its industry to be maybe earning more money than the entire industry. And you have to really think at that point, does that make sense? Is the growth going to continue at this pace forever? And I'm not saying that the market is fully pricing in 100% compounded forever, but you have to start looking with the higher growth of, well, what would happen if it slowed? And when might it slow? Because as companies get bigger, growth becomes more challenging. Because I think we can all agree that trees don't grow to the sun, but when it comes to markets, it seems like markets are pretty good in picking up changes in two directions. If it's growing, it can grow. If it's growing fast, it can grow fast. But when we start looking at growing extremely fast, I think we need to look at some extremes here because there's companies that get prices because they're growing quickly. When you look out a few years, you're like, okay, success is already basically priced in. How much higher can it realistically go from here? Maybe it'll succeed and it'll go much higher. But if the growth fails or slows, well, then you have some long-term downside and it will take a long time, if ever, for you to see the value of your investment back. And I'll get more to that in a second. Which leads to major risk too, in that it is dangerous to assume that a company can grow forever and keep all of that profit. Now, why is this? Well, because if there is indeed that much profit to be made, well, then there's going to be other companies fighting for a piece of it. And so let's say a company is working at a loss for a long time, trying to build market share. Well, if they have to raise prices to actually make a profit, well, then you could have other companies that undercut them. So realistically, there's always a fight for the profits. And on the same type of thing, it's dangerous to assume that a company can become an entire industry because, like I just said, there's always competitors. Plus, there's often already an existing industry that does something similar that will probably fight for the market share too. And often that involves companies that actually have money and have backing to fight for it. Now, I just wanted to make this graph so you could visualize what growth looks like and what slowing growth looks like too. Because here you could see different compound annual growth rates over time. So the blue one at the top, I think I'm not colorblind here, but yeah, so the blue one at the top is 100% compound annual growth rate. And you can see at the beginning looks close, year two still close, year three pulling ahead. By year six, it is way ahead of even 50%, which is the second one. And so let's say 100% growth turns into 50% growth. Well, that is a lot of lost profit, margin, whatever you want to call it, over time. And then if it were to slow to 25% growth, which is the bottom one, I mean, on this chart, you can't even see that I mean, it is growing. Trust me. I put the numbers in, the bottom one, but it doesn't even look like it because of how much less it is than the prior scenarios. But 25% compound annual growth rate, that's a amazing company. That's a unicorn. That's a great company that can do that for an extended period of time. Well, extended period of time. I mean, once you get into a multi-billion dollar company, I mean. Um, so the point being that when you look at this chart, you have to realize how much expectations or how much growth the larger compound annual growth rate percentages actually look like. Now, I want to be absolutely clear here. I am not saying don't buy hyper growth companies. Buy them. I mean, if you can, if they're going to achieve their growth. But just know if they don't, you could be in a lot of trouble. And that's why when you look at growth companies, you look at how much are you paying for this growth? Are you How much growth are you assuming will happen? Because you can look at two different hyper growth companies. I hate that word, still hate it. Sounds wrong. And let's say one is trading at 16 or 20 times earnings or forward EBITDA, cash flow, whatever you want to go with, and the other one's trading at 1,000. Well, if they both can grow at 100% compound annually forever, then they're both ridiculously cheap. However, let's say growth slows with both of them. Let's say growth slows to 20%, which is still great. Well, the company trading at 1,000 times earnings will probably fall a lot, and it probably won't recover for many, many years, if ever. Whereas the company trading at 16 or 20, well, that can still go up, even if the growth rate falls tremendously. So, how did I start this video again? Oh, yeah, I think I used the Buffett quote, price is my due diligence. And what I meant here is just that. If you are hoping for a company or you think a company can grow a lot, well, you can also buy a company that's not ridiculously expensive and will buy a lot. Just look at Geico. It was what, more than a 50 bagger for Buffett? And he bought it partially because it was cheap. Just something to think about. Anyway, that is all for today. I hope everyone enjoyed. I hope this got people thinking of maybe a new way of thinking about growth, or maybe something you hadn't considered. Maybe this helps. Anyway, I would love to hear your thoughts, and until next time, have a great day.